Welcome to this explainer. Look, today we're going to take a massive glossary of financial jargon and completely distill it down into a professional, no-nonsense survival guide for the modern stock market. So whether you're just looking for a really sharp refresher or you want a deeper mastery of essential market mechanics, you are absolutely in the right place. But before we can even talk about building wealth or making trades, we have to navigate this wild, sometimes pretty confusing landscape and answer a very strange question. What do dead cats, unicorns, and whales actually have to do with your money? See, the financial world has a language entirely its own, and quite frankly, fluency is your absolute best defense. So, we're going to treat the market like a strategy game today. We'll be working through 5 distinct levels: the foundation of the market, different types of investments, the mechanics of trading, valuing assets and strategies, and finally, market slang and scams. All right, let's jump right into level 1, the foundation of the market, covering the basic landscape of stocks and shares. Now, you already know the basic mood swings, right? A bull market means rising optimism in prices, while a bear market means prices are falling. But did you know the origin of those terms? It's actually based entirely on how these animals attack. A bull thrusts its horns upward, while a bear swipes its paws down. It's a great visual to keep in mind. Moving right along to level 2, different types of investments, focusing on the actual tools in your portfolio. Beyond just individual equities, you really want to diversify. You can buy debt through bonds to earn some steady interest, or maybe hedge your bets with commodities, which are raw, hard assets like gold or oil. Or for really broad exposure, ETFs and mutual funds are fantastic. They offer these managed, balanced baskets of assets that automatically spread your risk around. Now, on the totally opposite end of the spectrum, you have penny stocks. These are shares trading for under $5. And yeah, they definitely tempt people with those incredibly cheap price tags, but you have to know they are wildly volatile, they're often illiquid, and they carry a severe risk of total loss. Okay, level 3, the mechanics of trading. This is how you actually play the game. When it comes to executing a trade, it really boils down to what you prioritize: speed or price. A market order guarantees immediate execution, but it completely leaves you at the mercy of whatever the current market price happens to be. Conversely, limit and stop-loss orders guarantee your specific price target. But the catch? If the market never actually reaches your number, your trade just won't execute. What if you want to bet against a company? Well, you use a strategy called shorting. Basically, you follow 4 steps. You borrow shares, sell them instantly at a high price, and then you just wait. When the price drops, you buy them back, much cheaper, return them to the lender, and pocket that difference. But beware, because a stock's price can mathematically rise to infinity, shorting literally carries unlimited risk. And when that infinite risk actually becomes reality, you get what's called a short squeeze. Think back to that massive historic GameStop frenzy. If a shorted stock suddenly spikes in price, short sellers start panicking and buying back shares just to cut their losses. Well, all that mass panic buying acts like rocket fuel, pushing the price exponentially higher and violently squeezing out anyone who bet against the company. That brings us to level 4, valuing assets and strategies. It's all about choosing what to buy. Traders usually split themselves into 2 pretty warring camps. You've got fundamental analysts who care deeply about the actual business. They obsess over management, revenue, industry health, you name it. And then you have technical analysts who completely ignore the business itself. They focus purely on chart patterns, historical price trends, and the statistical psychology of the market. Furthermore, you've got to pick your specific strategy and timeline. Value investors are the bargain hunters. They're looking for stocks trading below their actual intrinsic value just because the market overreacted to something. Growth investors, on the other hand, are chasing high potential. They target young, really aggressive companies expected to scale rapidly, and they accept a much higher risk for the chance of a massive reward. Finally, we step into level 5, market slang and scams. Let's talk about surviving the wild west of market culture. In this space, you are constantly going to hear the term unicorns. Simply put, these are private startups valued at over $1 billion. Now, the name obviously implies extreme rarity, though honestly, in these modern tech booms, we definitely see these mythical creatures a lot more often. Now, when a stock is absolutely skyrocketing, enthusiastic investors will start claiming it's going to the moon. For anyone holding an asset, this is the ultimate dream, a totally stratospheric and rapid rise in value. But on the flip side, when an asset's price is collapsing rapidly, the market refers to it as tanking. It's the exact opposite of going to the moon, characterized by significant and really fast depreciation. If a stock is tanking, you really need to watch out for the dead cat bounce. It's a pretty gruesome metaphor, honestly, for a brief, deceptive recovery in a stock's price after a really prolonged decline. People might actually think the asset is saved, but that short-lived recovery is ultimately destined to just be followed by even more falling prices. And literally nothing causes an investor more psychological pain than getting jigged out. This happens when you panic, you close your trade at a loss, and then you have to sit there and watch helplessly as the market immediately rallies right back into what would have been a profitable position. But beyond just bad luck or panic, you have to be on high alert for outright fraud. A pump and dump happens when insiders artificially hype up a stock with false promises, and then they just dump their shares at the peak, leaving everyday investors holding the bag with massive losses. A rug pull is the exact same deception, it's just specifically engineered by the creators of small, unregulated cryptocurrencies. So how do you actually survive all this volatility in these scams? Your absolute best shield is consistency. You combine dollar cost averaging, which means just investing a fixed amount regularly, totally ignoring daily price swings, with the immense power of compound interest. Over decades, simply earning interest on your accumulated interest creates an unstoppable exponential wealth curve. We're going to leave you with this final thought regarding what's called the efficient market hypothesis. This theory basically states that share prices already perfectly reflect all available information out there. Well, if that's truly the case, is trying to consistently beat the market just a complete fool's errand? Does that make patience and time itself your single greatest asset? Think about that as you continue your own investing journey.